In this video, we're going to talk about analyzing common stocks. And in the first parts of these videos, we're going to concentrate on more macro kinds of questions, right? Looking at companies from a bigger perspective, if you will, than just the company itself. So the first thing we want to talk a little bit about, what is security analysis? Well, we need to gather some information, right? We need to put it in some logical order, right? And we have to have some understanding of how this affects what they refer to here as the intrinsic value of the stock. That is, it's a measure of the worth, right? And a prudent investor only buys a stock if the market price doesn't exceed what the investor thinks that the stock is worth. We've talked about this before. And there are several things we're going to look at with respect to intrinsic value over the next couple of videos. We need to have a way to estimate future cash flows. We need to understand the risk of the cash flows so that we can apply the appropriate discount rate to value the future cash flows. So in security analysis, one of the approaches to use is something called the top-down approach. Essentially, we start with economic analysis. We need to assess the general state of the economy, where we think that's going to go, and its general effect on business. The second part then, once we have an understanding of the economy, we need to identify what industries do we think in that analysis, in that particular predicted economy, will produce the best. Of course, the industries that perform the best will also have companies in it that are going to perform the best. So then the third phase is to look at what's referred to as fundamental analysis. How do we find those companies in the best industries that will perform the best? So generally speaking, right, we analyze the industry or the economy, and then we say, look, what are the top 10 industries based on this economy? So now we have 10 industries outside of maybe 100 or 150, depending on how you count them. So we have 10 industries to look at that we have identified as probably performing better than others. Within those 10 industries, we need to identify which companies will be best. So instead of looking at thousands and thousands of companies, we may have been able to eliminate and get down to a very basic, maybe 30, 40 companies that we might be interested in investing some of our money in. So who needs security analysis if we have something referred to as an efficient market? We've talked about efficient markets before. Essentially, they say that securities are rarely ever mispriced. So if they're not mispriced, then whatever price you see is a fair price. So you really can't investigate, or you can't be successful and investigate companies to find undervalued things, because everything has the right value. Now, the reason we still need fundamental analysis is because sometimes people make bad decisions, right? All of the people doing doing fundamental analysis, quite frankly, is why the market might be pretty close to efficient. But again, people always make mistakes. So if you think about economic analysis, right, we want to study the underlying conditions of the economy and how that might affect prices. As you can see here, here's the S&P 500 is the blue line, and these gray lines represent recessions. And what you notice is, let's look here around January of 2001 in this time frame, that the market was at a peak. And shortly after its peak, obviously at that peak, the implication is it's going to go down. The market's going to fall. Well, when the market starts to fall, we see that, well, gee, look, in a little month or two after that, we actually have what we refer to as a recession. Likewise here is the peak, and the recession happens after the peak happens. And likewise, here's the trough, here's the bottom, and after the bottom, we see that the market goes up. We're going to see that there's also the end of the market, if you will, or the cycle. So we want to look at economic data to try to figure out, what should we analyze? How can we determine or predict what the market's going to do in the future? So one of the things we can look at is the business cycle, right? We know that the markets go up and down. The business cycle goes up and down. In this case, one of the things we want to measure is something called GDP. This is the market value of all goods and services produced in a country over a given period. So if GDP is growing, that implies that the economy is growing. Industrial production, right, is a part of that, right? So it's an indicator of the output produced by the industrial companies. So these two things can be tied together. GDP is the general marketplace, including goods and services. Industrial production looks at one single part of that, which is more the manufacturing sector. So normally GDP and index of industrial production move up and down with the business cycle. So if you have a picture of those two things, you then also may have a picture of what the business cycle is or where you're at in the business cycle. So what kinds of things affect the economy? Well, certainly the government affects the economy with taxes, government spending, how they manage the debt of the government. All of those things will have an influence on the economy and the supply of money. The monetary policy includes that, obviously, but we want to look at the actual supply of money available to businesses in general, so we understand how we can finance and how companies can expand and grow. Other factors then are things like inflation, consumer spending, business investments, foreign trade, foreign exchange rates. It would be nice if we could gather this information. And what we'll talk about later is how you actually can do this and where you can find this information. So how you develop this outlook, right, is there's lots of sources that we can look at that will give us analysis, if you will, of where the economy is and where it's going to go. So essentially what we're looking for here is we want to investigate the marketplace and we want to ask questions, right? What industries will benefit or be hurt based on the economy? What companies should we avoid then? Should we maybe just evaluate specific industries or companies, right? The outlook on corporate profits and business investments is a critical piece of understanding where the economy is going to go in the future, right? If companies are not making money and or they are not investing in the businesses, future growth is suspect. We have to worry about what future opportunities there might be when we're investing. So there are a variety of variables that we can look at, and you can read through these, right? But if you think about real domestic growth product, right, it has a positive impact. If this number is growing, it implies that the market is growing. Inflation is detrimental to stock prices, right? So high inflation leads to higher interest rates, leads to lower PE multipliers, right? Generally makes equity securities look less attractive. And again, we can read through all of these variables and they all provide some picture, if you will, of where we think the economy is going to go. So the market itself is what's referred to as a leading indicator. We talked about this a little bit earlier. Typically, changes in prices occur before the actual change in the economy occurs. So if you watch the market, if you will, if you have a picture of that, it might be able to tell you in the ballpark where we think the economy is and where we think it's going to go. If you think about getting away now from the economy and looking at industries, right, we need to ask some very critical questions, right? When we're analyzing an industry, we want to look at things such as the makeup and the basic characteristics of the industry, the key economic and operating variables that drive performance, right? We want to develop a picture, if you will, of what makes the industry tick. From there, we need to figure out, well, what is the competitive position of the company relative to other industries? If we assume that the market is going to change or the economy is going to change, the position of the company within its industry is also going to provide some insight into where that industry or that company may go. We need to identify, again, companies within there, given their competitive position, if you will, within the specific industry. All of those things will have an impact on where we think the future is going to be. So we want to ask questions about the industry. What's the nature? Is it regulated? Is the labor force an important component of industry performance? Right? What about technology? Do we know what economic forces are really driving industry performance, right? So there's lots of questions we can ask about the industry. We might need to understand a little bit about the growth cycles of industries. And again, generally, I'm sure you've seen this in other classes, but when companies are in their infancy, right, there's very high risks, right? You don't know whether success is in the future or not. We're waiting to see how the company grows. How do things filter out, if you will? So as it grows, eventually it'll get to a point of mature growth. And from this point, again, we're still growing, but the long-term nature of the industry, you may be able to see that it's coming to an end. Now, what happens with most industries is once they get to this mature growth phase, something in the industry takes over and revitalizes, or recharacterizes the industry so that it continues to grow in this mature growth phase. So we can get information from lots of places, right? Well, the S&P industry surveys, we can go to Yahoo Finance, Morningstar. There's lots of articles and places where we can get information about an industry. So again, what we're looking for are what are the prospects for the industry and industry growth given the forecast of economic activity. That will then lead us to be able to identify certain industries that we want to focus on over the next year or two with respect to our investment plans. So that's a brief introduction, if you will, of how we analyze the economy and then how we analyze the industry. And it is brief, right? It's not in a lot of detail. Much of this analysis is very industry specific. So if you go to work for a company in the technology area, the kinds of financial analysis that people do in technology can be very different from the kinds of analysis that's done in the beverage industry, for instance. So some of this is taught, if you will, or trained once you find the place where you're ultimately going to have a career. So again, industry analysis and economic analysis is not as easy as as what it might seem, although it might seem kind of complicated actually. But it's not an easy process to get through.